The official narrative for 2026 is that the global labor market has stabilized. The United States reports a 4.4% average unemployment rate, while the European Union sits comfortably at 5.5%. But if you are actively trying to hire a team or secure a job right now, those top-line numbers shatter upon contact with reality. Your personal economic situation in 2026 is entirely dictated by highly specific geographic zip codes, not continental averages. Relying on generalized national safety metrics to make your next relocation or business expansion is a trap. It leads directly into localized recessions hiding right beneath the surface. Take the United States. While the national average sits near 4.5%, Washington, D.C. is dealing with a 6.7% unemployment rate, following a massive reduction in the federal workforce. Across the Atlantic, the European average masks severe localized distress, with Finland's unemployment rate peaking at an elevated 10.2%. This scatter plot reveals the extremes under those flat averages. Finland and D.C. struggle, while South Dakota and Russia sit at 2.2%. A structural gap has formed, a strict divide between top-tier bottlenecks loaded with friction and bottom-tier tight markets depleted of talent. The uniform idea of a broad Western economic dream has fractured. Navigating this requires a completely localized framework to decide exactly where to allocate your talent and capital. Consider the prestige bottlenecks. These are the legacy Western hubs that carry immense cultural capital, but currently suffer from the most severe labor friction. In Europe, this includes countries like Spain, which is battling a 9.8% jobless rate, and France, sitting well above the regional average at 7.7%. In the United States, the coastal equivalents are facing this same sluggish reality. California is stuck at 5.5% unemployment, dragging the broader West Coast average over 5%. Entering these specific markets means accepting a grueling reality: prolonged job searches, fierce applicant competition, and structural constraints on economic growth. Workers and companies continue to flock to these areas, drawn by high-quality social infrastructure and a perceived historical status. But choosing a prestige market in 2026 requires an active trade-off. You are intentionally exchanging practical career momentum for cultural geography. Historical complacency carries an immense risk. In just 12 months, Delaware saw a massive 1.6% spike in its unemployment rate. Ignoring year-over-year momentum data can easily trap a relocating professional or a new business founder in a rapidly deteriorating local sector, regardless of a state's traditionally safe reputation. Contrast that sudden volatility with the long-term recovering markets in Southern Europe, which have spent the years since 2008 rebuilding their labor forces. Italy is a prime example. Its 5.1% unemployment rate now actively beats the European average. Looking at this line chart of Italy's youth unemployment, we see a dramatic structural correction. The rate plummeted from a 40% peak in 2014 down to roughly 20% today. When evaluating a region's true economic utility, trailing momentum and recovery velocity matter far more than legacy reputation. On the opposite end of the spectrum are the economic fringes. Non-EU nations and U.S. interior states are currently experiencing extreme talent shortages. In Europe, countries like Switzerland and Poland maintain highly stable, low unemployment rates at 3.2% and 3.1% respectively. Russia holds the continent's lowest rate among major economies, operating at just 2.2% unemployment. In the United States, Hawaii mirrors that exact 2.2% rate, driven by a sharp 0.8% drop over the course of the last year. These tight markets offer immediate job placement for workers. The trade-off is that they often come with lower baseline wages or highly complex geopolitical realities. For employers, the math flips. These 2% zones represent a severe operational bottleneck because the local talent pool is entirely depleted. Full employment is a dream scenario for the job seeker, but an absolute nightmare for the company trying to scale. We can map these strategic options using this 2026 decision tree. The first step divides the audience into buyers and sellers of labor. If you're a founder needing to aggressively scale a team this year, we follow the buyer's path. Founders must avoid the 2% unemployment zones. Hiring in a depleted market means bleeding cash on impossible recruitment. The optimal target zones for scaling a business sit in the 5% to 8% brackets, providing a lucrative buyer's market for talent. This means targeting regions like recovering Italy or cooling tech-heavy labor markets across the West Coast. Successful founders in 2026 gladly trade slightly higher bureaucratic friction in these areas for guaranteed access to a desperate, highly qualified talent pool. Pivoting this decision tree, we look at the job seeker trying to maximize hiring leverage. If selling your labor, avoid prestige bottlenecks. In places like Finland, DC, and Spain, candidate oversupply destroys your negotiating leverage. Job seekers need to target the lower end of the spectrum. The greatest leverage exists in non-EU strongholds or low unemployment U.S. states. Targeting these fringe zones requires trading the status of a traditional cultural hub for rapid career acceleration and immense negotiating power. Geographic prestige no longer correlates with personal economic success or job security. There are no universally good economies in 2026. There are only economies correctly aligned with your specific strategic needs.